All right, well, I'm going to get us going here. It's already almost 11:05. I want to be respectful of everybody's time. I'm going to try to get through this presentation in about 40 to 50 minutes, okay? Since it's such a small group, if you guys have questions, let's just stop and go through them right now, and then we can keep going. And what we're going to do today, this is what I'm calling the Bulletproof Buyer Program. The idea is you guys can take this presentation and deliver it to your clients, okay? And give them confidence to go out in this market. We've got Katie from Colorado, Brad and Steven are here in Park City. So we're from a little bit different markets, but we're all experiencing the same problem, which is massive inventory shortages and buyers. I don't know if there's ever been as hard a time for them to go find a house right now and get under contract. The odds are stacked against them. And I think from you guys, I'm hearing from my buyers is just, they're completely feeling overwhelmed. They're beat up. They want to quit, right? And a lot of them are saying even like, hey, I'm just going to wait for things to get easier, right? So I think I'm going to give you guys data to take back to them and say, look, like, yes, it's hard right now, but it's not going to get easier anytime soon, unfortunately. So let's talk about strategies to make your pre-approval stronger, what we can do with an appraisal gap strategy. And then we'll talk about potentially making some clients an all cash buyer through this new program called Revive. So I'm going to start off by sharing my other screen here. Let's go through it. All right, can you guys see my screen here?
Yes, sir.
Right, yep. Awesome. All right, let's start the slideshow here. Okay, so again, this is geared towards your buyers. So, the questions are kind of geared towards asking them, like, how are you feeling right now? And again, most of my clients are telling me they're exhausted, they're frustrated, they're tired of looking at endless properties, submitting endless offers, right? So again, just trying to gauge their involvement right now and how they're feeling. Again, that's what we're hearing from clients. We're even hearing it from other team members in our office. They're trying to buy their first homes. They're just feeling like this is a terrible time to do it. So, we think the buyer needs a couple of things. They need the data to be empowered and make sure they're making, if they're going to stop looking, right? We want it to be a factual decision based on data, not an emotional one, which is what most buyers are doing right now. They're making an emotional decision. They're seeing the media perpetuate stuff that this is a housing bubble, right? So they're using their emotions to cater to their decisions. They need a plan on what's going to happen if their appraisal comes in low. We know that's happening across markets in the country right now. Appraisals just can't keep up. So we'll talk about that. We need to be able to close really fast. We want to make the buyer look like a cash offer as much as we can. And the last piece, for some clients, we want to try and turn them into a cash offer if possible. So we'll talk about Revive, okay? All right, so and that kind of just sums up those 4 points that we just went through. So let's start with the data, because this is the best place to start with your clients. Now, we're all in different markets, and I think as realtors, we get very granular about our markets with our clients. But if we're going to subside their fears and make them feel confident about this market, we need to also look at the macro level, right? Because a lot of that data is going to tell us where the rest of our markets are going to head, and also kind of give people confidence that, maybe Park City or maybe, the foothills of Denver are going to be okay, but the rest of the market's going to implode. That's really not the case. So you guys have seen probably this data before, but this is to kind of show your clients, okay, look, since 1977, here's this kind of average line, right? So it's about 1,500, 1.5 million housing starts per year since 1977. We can see that increasing really dramatically going into the Great Recession in 2006, 7, and 8. And then look, since 2009, we've been well below this 1.5 million homes per year average, right? Seriously low. Even going into 2020, we were finally starting to break above that. Then COVID hits, everything gets shut down. We take another dip. And you guys know about all the challenges now this year in 2021 with lumber prices, supplies for construction. Housing starts just are nowhere near where they have been historically for the last 50 years. So start with the data for your clients. Look, the first piece to look at is housing starts, the ones that are actually being built have been behind for a number of years. And this is another way to show that same data to them. Again, there's that 1.5 million average line right across the top. Here's those really hot years in 6, 7, and 8 where we're way overbuilding actually. And then here we are 13 straight years below that 50-year average. And at this point, the NAR is saying we're basically 4 million homes short in this country for new housing starts, okay? So, and again, that's just buildup of 13 years because builders got so badly burned in 6, 7, and 8. So you guys know they're only building communities of 50, 60, 70 homes, maybe at a time, right? Up in Park City here, they only do like maybe 15 to 20 at a time, right? You know, back in 6, 7, and 8, we were running communities of hundreds of homes at a time, right? And builders were only pre-sold maybe 20 to 40% of those. Now builders are pre-sold 95 to 100% of the time. So just much different evaluation for your client. Yes, it feels like 2006, 7, and 8 because home prices and then the housing market is basically in vogue, right? But the data is just so much different. Here's existing home inventory, so not new construction. This is what's available in the market. Again, this is going back to pre-2001. You know, this is the months of or millions of homes available. And again, we're all the way down since 2013, well below that average of 2.5 million. Just not enough homes of existing even available for clients to go look at. And again, right here, we're entering basically 1 month of inventory since 2020. You guys are feeling that. There's just nothing available in most counties across the country. Okay, this one's also good to look at. Here's the peak of supply homes. Again, available in 2007, we were all the way up to 3.7 million homes available nationally. We're down around 1 million right now. It's a 70% change, right? So again, things look the same in terms of the competitiveness, in terms of pricing skyrocketing, but in terms of, you know, the actual data of homes, it couldn't be more different, right? This one's fun. This is a state by state, and I think this is good for you guys with clients moving from other states into where you're coming, or if they're moving out, or again, just to give them a macro piece of data. Look at the year-over-year change across every state. Utah down almost 70% year over year. Colorado down 51%. I do business in North Carolina. They're down 64%. In fact, the only states that aren't down more than basically 30% are New York and Hawaii. So, and we all know everybody basically wanted to move out of New York because they didn't want to get stuck in their 400 square foot apartment for a year. And Hawaii, I think they just lost a ton of jobs with COVID just because it's basically a tourism state. So, but again, just this is a national issue. It's not just even related to our specific, even our specific states here. Again, just another way to look at this. This is the months of available inventory. Again, just couldn't be way more different than 2004, 5, 6, and 7, where we skyrocketed almost 10 months of available inventory. There's 12 homes for your client to go look at a weekend. Now we're down to less than 2 right now, even into 2021. Okay, these are some of my favorite slides, and I think this kind of gives even more backing to the point that, again, we're not entering a housing bubble. This is the number of births every year by generation. You can see that as a baby boomers kind of eclipsed up into 4 million births. And then you came into Gen X and we had this little trough right here. And then the NAR tells us, the National Association of Realtors, the average first-time home buyer is 33 years old, okay? So in 2006, the average first-time home buyer would have been born in 1973. That's right here. Okay, and we entered another trough right there. That's because Roe v. Wade was passed and abortion became legalized in the United States. And we saw another big drop off in births. So this is important data to show your clients. We're going to go over the mortgage credit availability index in the next slide. Everybody says, look, like everybody who could fog a mirror could get a loan, right? And that was true. But the other issue is we were basically overbuilding homes because this had come down 25% just in those couple of years right here going into 1973 in terms of the demand for homes, right? But we were actually building more homes than we ever had. Fast forward to today, this is not even close to the same scenario. Here we are right here today in 2021, going back 13 years, or excuse me, 33 years to 1987, 1988, consequently when I was born actually. And you see we got increasing bursts over the next few years. And then look, it's not even going to ever go to another trough like we saw back in Gen X time. So there's actually more demand coming, and that demand really might flatten off for a number of years, but it's going to stay around 4 million homes that we need per year to keep up with the amount of people being born in this country. Fascinating slide. Again, I think the overbuilding of homes is something people like to kind of just gloss over when talking about the Great Recession. And then this one, I think this is just a funny slide too. This is from the Mortgage Bankers Association, showing basically a mortgage credit availability index. So yeah, basically in 2006, 7, 8, this is where you've got your taxi cab driver who basically got under contract on 15 homes, all with 0% down with his 600 credit score, right? So basically, again, you could fog a mirror, if you could breathe on me, you got a loan, right? Plummets in 2009 because that was a big reason for the housing crash. And again, mortgages have really just never been tougher to get right now. And look, coming into 2020, COVID annihilated our guidelines and made them even harder. So the people that are buying homes right now are extremely credit proficient and have been double checked. So again, we're not going to see this big rash of foreclosures coming. I'm going to talk about that piece here in just a second as well. This is another way to look at that same data, but basically this is from the Urban Institute talking about default risk in this market. And this is broken into product risk and then also the borrower risk. So basically the riskier the products we were giving, but also how much risk was falling back on the borrower. Again, look, this was when we were giving those negative amortization loans, right? So as you made payments, your balance actually went up on your mortgage. I can't believe we even did those, right? Now fast forward to here, you know, borrower risk is at an all-time low. Product risk is basically at the exact same levels, right? We're just not giving away free, easy loans anymore, okay? And this is another piece, and let's talk about those foreclosures for a second. If people, you know, I had clients say, look, I'm waiting for this foreclosure pandemic kind of come once the, you know, the CARES Act kind of expires. We feel like a lot of people are going to be short on their homes. Well, if that's the case, then that would signal that people aren't sitting on massive amounts of equity. But look, just year over year change in people's home equity in their home, on average in Utah, this doesn't matter, this is on average, you had $40,000 you gained in equity just in the last year. So yeah, you may just have defaulted on payments, but you're just going to turn around and sell your house. It'll be gone in days, right? Even if you put it on for a little bit of a discount, you're not going to go into foreclosure. So we're not going to see all these foreclosures hitting the market because everyone is sitting on massive amounts of equity at this point. So I think that piece is really, really key to take back to your clients there. Cool. So that's a little bit on the market data. Any questions on that before I move on to appraisal gap strategy? All good? Cool. Was that helpful?
Actually, add one point, Jason, that I find interesting too. So with the birth rate slide of the 33-year-old, I'm curious too, in the last 30, 60 years, the death rate and the average age of people, how old they are, and they're holding houses longer as well. If there's any relation, you know, that makes this slide even stronger, I'm curious.
That'd be an interesting to look back on. I haven't gotten data on that before. You know, one way to correlate that backwards though is, right, so baby boomers all right now should be selling out of their mega mansions, right? That was such a popular thing in the early 2000s, those 4, 5, and 6,000 square foot homes. You see them littered through the Heber Valley down here, and especially through like parts of Littleton, Katie, right? Like just these massive old homes that are outdated. The baby boomers would love to get out of that house and get into like their single level ranch, right? But they've done two things. One, they've probably refinanced now to a rate that's less than 3%. And two, they know if they go get a house that's half the size, it's going to end up costing more. And they're saying, well, what's the point, right? Like, I'll just stay in the house. So that's the other thing that we usually count on is this cyclical thing of homes from previous generations where they're downsizing. We count on that inventory coming back to the market, but we're not getting that either because baby boomers are saying, I can't sell my house. Not only am I not going to find one, but I've got a super sweet interest rate. Why would I want to get rid of that?
Yeah, that's what I was thinking.
Also, cool. To follow up with that as well is, you know, the baby boomers were into the mega mansions, but Gen X was into owning multiple homes.
Great
so
point
we're
too.
Seeing that too.
Yep, absolutely. And also the trend, millennials don't really want those mega mansions, right? We're not really all that interested in these big old homes. We want to be near our towns. We want to be near the bars and the restaurants. And we want it to be kind of, you know, trendy and chic. We're not interested in having 6 different bedrooms. That's really just not what millennials are after. So cool. Brad, did you have anything to add?
No, I think you guys are spot on. I'm seeing all the same things.
Cool. All right. So let's talk about the appraisal gap strategy. It's really important when you guys are teeing up your clients right off the bat. If they're getting a mortgage, hey, you're going through an appraisal process, right? So this is one of the, I mean, even 6 months, 8 months ago, I really wasn't having this conversation all that often with clients, but I think it's imperative right now when you're counseling the client, one of those pieces has to be, look, if you're going to win in this market, you're probably going to have to overbid on the home 2, 3, 4, 5%, right? But if you're going to win that bid, having overbid on it, it's natural to assume that the appraisal very likely might come in short, right? Appraiser is not going to have data to go back to and say, "Grab, there's comp supporting this already now overbid price." When people are bringing listings to the market right now, it's typically already at the tippy top, right? So again, then we overbid that price. There is no appraisal data to fall back on. So the client needs to have some kind of appraisal gap strategy. So I want to show you guys where this really can work for a client and show them the math behind it, so they don't get so scared and say, well, I'm not gonna put in bids then knowing that the appraisal is going to come in short. Okay. Now I want to be clear, the strategy really works for clients who are probably doing 10, 15, or 20% down. If you're relying on like a down payment assistance product like Utah Housing out here in Utah, or like Chaffa back in Colorado, or if you're using like 0% down DA and you've just got limited assets, unfortunately, your appraisal gap strategy is go get a gift from family. There's just not much else to overcome that. But let's look at a scenario. This is a client we had who was buying for $800,000. They were doing 20% down on a conventional loan. Okay, so this is the information we showed them right off the bat on what their mortgage strategy was going to look like. Okay, so at 20% down, they're going to end up at a 3.25% rate. They're going to get a payment of about $3,700 a month with taxes and insurance. Okay. This guy's, and again, part of this is you need to ask your clients, like, what's the most important thing to you? Is it monthly payment once the appraisal gap comes in short? Is it your cash to closing that's the most important, right? There's different factors that are going to trigger for each client. In this guy's scenario, he said, look, I've got 180 grand. I don't have any more. Like, that's it. I'm tapped. So he said, okay, right. In this scenario, the appraisal came in $75,000 low. Okay. So, client's freaking out saying, how are we going to solve this? So here's what we did. We moved him from 20% down to 10% down. So basically, instead of an 80% LTV loan to 90% LTV. Then what we did, what was important is we want to keep his payment in the same range, right? So what we were able to do is keep the rate at the same point. We bought out the mortgage insurance up front. That's something you can do on conventional mortgages, okay? And then we were able to use the other $75,000 for him to cover the appraisal gap. Okay, so let's walk through the math on that on this next slide here. So again, purchase price is $800,000. The appraisal comes in at $725,000, so we're $75,000 short. So instead, we moved him to a 10% instead of 20% down payment. Okay, so his loan amount is a tad bit higher. Closing costs remain the same. So do the prepaids for the taxes and insurance. We're going to buy out that mortgage insurance premium at the upfront. So we have a bit more in closing costs to buy out the mortgage insurance. Now he's left with the $75,000 that he can make up for the appraisal gap strategy. Interestingly enough, when you're actually over 80%, you actually get a tad bit better interest rate. So we're actually able to pay for almost that entire mortgage insurance premium. It's weird. The agencies actually like you taking mortgage insurance premium because there's actually less risk to them. So there's actually a better incentive on rates when you take mortgage insurance. I know it doesn't make much sense, but that's how conventional mortgages are built. But again, for this client, we ended up at basically the exact same cash to closing, the exact same monthly payment with him bringing 10% less down on the loan amount. This is important to tell your clients, like, hey, look, we've got an appraisal gap strategy. This is how we are going to overcome it. It's going to be reducing your down payment, working around the mortgage insurance, and we can still figure out, even on this one, that was a 10% decrease in the appraisal gap, which is pretty extreme, and we're able to overcome that with the client. Questions on the math behind that?
Yeah, Jason, when you talk about mortgage insurance premium, by paying that $3,600, does that mean the client does not have personal mortgage insurance?
Correct. So on conventional loans, you have several ways to approach mortgage insurance. The most common and what most lenders do, and just because that's the only thing they know, is called borrower paid mortgage insurance. That's where you see it built in your monthly payment, okay? And that will fall off, right? Once you reach your 20% equity in the home. There's also single premium mortgage insurance, okay? And that's where we buy it out on the front end at the very beginning, okay? There's also lender paid mortgage insurance where we increase the interest rate and pay for it all for you as well. So there's actually 3 different ways to approach mortgage insurance. Most lenders only know about that first strategy. But again, this is a way to add a little bit extra in closing costs, but at the end of the day, end up at that exact same mortgage payment. That answer your question?
Yeah, it's a little surprising to me that that change in down payment doesn't affect the interest rate either.
Yeah, again, it's kind of interesting, but rates are always a slightly better when you're above the 80% mark because you're taking mortgage insurance premium. That is insurance to the agency, right? In case of default. So to them, it actually is a safer loan, right? Because there's actually an additional layer of insurance protection to them. So because of that, they're actually willing to give you a better interest rate because it's so funky. But yeah, once you get to 20%, you'll see a small 25 to 50 basis point adjustment on the interest rate once you get below the 20% mark, strangely enough, on a conventional loan. Cool. Any other questions on that, guys?
I just have one, Jason, as it relates to contracts, and maybe Brad. Sorry, is it Caitlin or Katie? Katie. Sorry. When you're seeing these come through, so obviously you don't know the appraisal is going to come in at 725 at this number. And when you're writing an offer in the contract, how are you seeing this worded are you having a number that's being decided upon when you're writing this offer? I'll cover up to $50,000 in appraisal gap, or what's the best strategy there?
Katie, Brad, you guys want to take that one real quick?
Or what's the best strategy for writing an appraisal gap?
No, so I'm just saying here. So on this specific example, the purchase price is $800,000, right?
Mm-hmm.
And the appraised value is $725,000. You obviously don't know that. So in writing an offer to stay competitive, you want to include this appraisal gap strategy in your offer. Are you defining a number when you're writing these offers? I mean, the answer is yes, but I just don't know what number you do. You don't know it's going to appraise that low at 725. So it's just based off comps. And I mean, is there just different ways to write in an appraisal gap to make it a part of the contract that's floating, that's adjustable, if that makes sense?
Yeah. So I always put, instead of, I don't know which section in the contract it is, but when it always says like, I will buy this home for, and you put in the amount, I always just put purchase price. So then we kind of have the flexibility to float with it. And then I mean, I've just been doing like a full appraisal gap coverage, but I will say specifically in my contracts, like if it does not appraise to, let's say the home was listed at 425. If it does not appraise to 425, we have the right to back out of this contract, because if it doesn't even appraise to that, then.
Got it. Okay. No, we've done the same, just in defining a number, say $25,000 appraisal gap. And I just didn't know if there's a strategy to float it somehow. So.
I think that's just, you want to prepare your clients up front, right? Like, hey, this is a pretty extreme scenario. This is a 10% lower on the appraisal. Like, I'd say this is probably less likely to happen. We're probably more looking in this scenario like it comes in at 775 or something like that, right? But this is the way to go to your client and say, hey, look, yeah, you're overbidding on the home by 75 grand, or maybe in this area, maybe it's 100, right? Maybe the house was listed at like 700,000. It's important just to go back to them and say, hey, look, in the event this does appraise drastically lower than what we're offering, we can still get you into that same payment, same cash to closing, so that they feel comfortable writing that into the contract. Because unfortunately, what I'm seeing for clients in Colorado, clients in Utah, is they're overbidding on a home by 50 to maybe 75 grand, but they're only putting in there 20 or 25K in appraisal gap coverage. To a seller, if they've got a cash offer that's kind of somewhere more back, maybe below their offer, but doesn't have the appraisal side, they're still going to take the cash offer, right? So we just want to empower the clients to tell them, hey, look, even in drastic scenarios where it comes in 10% lower, the math can still work to get you to your cash to closing and payment scenario that you want.
Got it. Oh.
Cool. That's what I would be doing, is just having that strategy session to be like, hey, this is an extreme scenario, but this is where the math can work out and get you there. Let's write it in the contract, even though I never think that's probably going to happen when it comes back.
No, I know. And again, you base that off of the comps, because we know just as much as appraisers of what's sold on historical data. We're not doing appraisals, but of course we know what stuff's worth. So having that conversation, yeah, I get it. I was just didn't vocalize that as clearly as I was thinking, but thank you.
No, you're fine. And I think most agents are probably thinking the client's just got to come up with extra cash every time there's an appraisal gap shortage, right?
Yeah.
There's other strategies to get there. And if you can counsel your clients on that, they're going to feel more comfortable expanding that appraisal gap coverage that they're willing to give in the purchase contract, which is going to accelerate their chances of probably getting on the contract as well.
Got it. Okay, cool.
And kind of what Jason said too is, you know, I'm changing it like kind of similar to the down payment side where it's like, yeah, you intentionalize putting 20% down, but because the appraisal gap, you're having to use so much cash, then you can adjust it accordingly.
Got it. Use your down payment cash to cover.
100%. But again, if you take them this slide, they're gonna feel like, well, if I have to use half of it, I'm gonna end up in a much worse situation in terms of my loan and my payment and everything else, right? You can show them like, actually, no, like, and again, come back to me and I can build you guys those total cost analysis that look like this one and walk them through the math so they feel comfortable about that, right? Like it's one thing to hear it from you guys, but if I send them the data back in a presentation, they'll probably have that extra level of comfort too. So
Cool.
Cool.
Steven, I'm wrestling with exactly those challenges with a client right now, and figuring out the best strategy has been so difficult because we have, you know, multiple approaches now with these new addenda that have come out.
Yeah.
And I've done both ways. We've written probably 6 or 8 offers now and no success yet, and feel like it's just what you mentioned, Jason. It's like someone comes in with cash that maybe their offer's not quite as strong, but you know, because of that appraisal gap, they say, you know what, this is a better bet.
yeah. So let's sit that client down and get them comfortable with like a big amount in appraisal gap strategy and how the payment and everything else will stay the exact same. Are they doing 20% down?
Yeah, this is really helpful for me because like seeing how these numbers can work is helpful to me to be able to explain it to her. And we haven't had this level of understanding. And so we're looking at the appraisal gap and with a level of concern, you know, that it's big money for her and she's a friend of mine. So it means a lot to me to make it work for her.
Absolutely. And separately, here's another scenario. This is one where the client was definitely more worried again about cash to closing. And this was actually even a jumbo scenario where we had 20% down. We pivoted to a 10% down jumbo product. Now that does lead to an increased interest rate. But again, these scenarios, so they did end up in a higher payment by $400. But to her, she was like, man, on a $1.5 million home, I don't care. I just want to get into the house, right? So again, these numbers can still work even on the jumbo side if done correctly. You know, we got to always make sure that the client's still going to qualify for a 10% down jumbo product because those have little bit different guidelines and reserve requirements. But again, this strategy isn't just solely focused on doing a conventional loan. So this slide can help show you that, yeah, even in bigger purchase price ranges, this strategy works pretty similarly as well. Okay.
So on Jason, sorry, on this one, you just increased the interest rate?
Yeah,
same cash to close.
Yeah, so cash to close, again, about the same. In this one, the appraisal came in basically 10% low. So instead of coming in at 1.5, came in at 1.35. Okay. Then we built them on a 10% down jumbo product, which we have access to at Neo here. It does lead to an increased interest rate by about 0.5% on a 30-year fixed. But again, it gets them into the house, right? And the exact same cash to closing, yes, at a little bit higher monthly payment. But again, on $400 on an almost $7,000 monthly payment, you're still talking about a 4 to 5% change. It's not huge.
Yeah, 9 times out of 10, $1.5 million house, that $400 is worth it to get into the house.
Yeah, totally. That probably seems little consequence to most clients. So, okay, so let's finish up the appraisal gap strategy. Same thing. If you guys want to come back to this, it just walks through the math on how we did that, so you can show that to your clients in the exact same way. Okay, let's talk about pre-approval, because again, I think the pre-approval process is super key to your client. I like to think of pre-approval or basically getting your client ready for pre-approval in 3 stages. Some lenders out there will do pre-quals. I don't do any of those because those are a complete waste of time. But basically, that's us having a chat with your client and saying, everything looks good, right? Here's your pre-qual letter. If they're even getting one of those right now, that's not going to get you very far, right? What most lenders are doing is doing a pre-approval, okay? So they're taking the client's data, their credit score, assets, income, credit, and then running it through an automated underwriting system, okay? There's desktop underwriter for Fannie, and there's loan prospector for Freddie, okay? But they run it through the automated underwriting system. System says, good, spits out an approve eligible, so you're good to go. Can't run these on jumbo, by the way. You have to go through what we call manual underwriting. So again, when you're doing a pre-approval, just basic on a jumbo, you're kind of just looking at everything more like a pre-qual and telling the client, it looks pretty good, okay? We realize the next step past there is to do a fully underwritten pre-approval. This is where we can gain more time and a better way to submit a better offer. Because if we do a fully underwritten pre-approval, so we send them all the way through underwriting up front, now we can submit an offer in especially conventional, as long as we can get the appraisal back in time, 15, 16, 17 days. If we're doing jumbo, we can do 24, 25, 26 days. Again, appraisal dependent, but we can shorten that timeline on their purchase contract drastically, okay? So again, getting the client, now we ask the client two things. Are you ready to move forward with us? Like 100%, because if they're still shopping us as a lender and we're gonna go spend 8 hours of my underwriter's time getting them fully underwritten, I'm going to say, you know what, you're not quite ready yet, right? So they need to be ready to fully commit to us. And B, they need to be ready to submit offers in the next 30 days, because a fully underwritten approval means we're going to keep coming back to your client for updated pay stubs, bank statements, if they're self-employed, profit and loss and balance sheets, right? We don't want to do that to them if they're just kind of, I'm just looking, right? But if they're like, hey, I'm ready, I'm going to pull the trigger any minute. We have hired additional underwriters at our new team here at NEO to just do these underwrites, okay? So all they're doing is getting your client fully prepared up front so we can cut time off on the back end, okay? And if we can do that, we can remove the loan contingencies, right? We might not necessarily want to remove appraisal, although if we've had a really good appraisal gap strategy and the client's comfortable, shoot, maybe we can remove both of those, right? Now we're really close to looking like a cash offer. So if we can work towards that fully underwritten pre-approval, that's key to getting your client under contract probably even faster. Realize this takes more time up front. So if you've got a client who's just starting their search, just starting to think about it, talk to them about this and say, look, most lenders can get you a pre-approval in 24 to 48 hours. We all can, because it's really easy to submit that through the automated underwriting system. But if you want a fully vetted, like golden ticket, right, to get out there in the market with, it's going to take probably a week or two up front to get all the way through underwriting and get through all those steps and get everything verified. So just get them on that path a little sooner if they feel like this is going to probably help them. Questions on that? Cool. All right, last piece. I'm really excited about this one. We have a new partner called Revive, and they do a couple of things. We're going to talk about their trade up program right now, but they also offer a separate program, and I'm forgetting the name of it right now, but it's basically a no cost renovation loan for your client's departure residence. Now, this program is really geared towards a client who already owns a home and is probably sitting on a pretty good amount of equity, okay? A lot of clients I talk to are saying, yeah, I'd love to go buy that, go upgrade to that next house or downsize, right? But they're saying, shoot, if I sell right now, I'm probably going to be homeless for a while. I'm not going to know where to go, right? They're really scared of like, I'm just going to be sitting around waiting. Or if they're submitting a contingent offer, we all know that the chances of getting a contingent offer accepted in this market are basically 0%, right? So here's what Revive does. Your client needs to get fully underwritten again. So we have to go through that full TBD, basically to be determined pre-approval underwritten. Revive makes an all cash offer for them on their new house. So it goes and buys the house for them all in cash, okay? So they basically can act like a cash buyer. They can close in typically 14 to 20 days through Revive. Depending on the client, they typically will still keep the appraisal and inspection related items in the contract. Unless the client wants to waive them, they can do that. But I would still probably suggest at least keeping the inspection stuff in there. Your client closes in cash with Revive. Now they can take up to 12 months to sell their current home, okay? So they're not under pressure to get it sold really quickly, so they're not taking any kind of discounts. They can also take time to renovate it and get it fully up to market standards. If they sell their previous departure residence, now they buy the house back from Revive, no markup. Revive sells it to them the exact same home at the exact same price that they purchased it for, okay? Revive charges a 3% fee of the loan amount. And again, they require 20% down. So again, this is not going to work for your client who's doing 5 or 10% down, okay? They've got to have 20% down committed. But again, if they're willing to pay a 3% fee of that loan amount, so let's say it's $1 million purchase, 20% down, so it's an $800,000 loan amount, your fee to Revive is about 25 grand. So it's a bit expensive. But with home prices skyrocketing so quickly, I've had some clients who are saying, I don't care, man, I'm happy to pay a 3% fee. I'm going to lose that in the home price in the next 6 months anyway, right? So again, Revive buys it for them in cash. They get the time on the back end to sell their house, and then they buy the home back from Revive. And the nice thing is, you're not in any kind of deadline crunch when you're buying the home back from Revive. You can do a 45 or 60-day contract, right? We can take all the time in the world we need, and we're not hair on fire trying to get a deal done in like 20 days. So again, Revive will really turn your clients into an all cash offer. Again, probably the caveat is they need to have that 20% down. They don't necessarily need to have a departure residence to sell, but that's been the biggest clientele as I found is like, hey, I'd love to sell my current home again into the next one. I just don't know how. They're thinking about bridge loans, but bridge loans tend to be really tricky and kind of a pain in the ass, honestly, going through most of those brokers. This is kind of a new bridge we found that makes it honestly a lot easier for the client to figure out a way to be a cash buyer. Questions on that product?
So you said 45 to 60. Go ahead, Brad.
Can you use the equity from the home you sell as the 20%?
100%. That's exactly the idea they have behind that. Yep, absolutely. That's why I think it works so well for somebody who's got a home to sell, right? There's clients walking around out there with 20 to 25% down, right? They're probably going to give you a little more pushback on a 3% fee from Revive and then all the other normal closing costs that we're going to go through once they purchase the home back from them, right? But again, with clients sitting on large amounts of equity, this is their biggest challenge is how do I get into a house while selling this one at the exact same time? Steve, what'd you have?
Oh, just the deadlines for, you mentioned 45 to 60 days of a time frame to renovate and or find a new house.
Yeah, so Revive will basically turn into a cash offer. Typically Revive is like 14 to 21 days to close on their cash offer. Okay. So it's very competitive there. Client has up to a year. It's 6 months for the first 3% fee. If you need another 6 months to get out of that departure residence, it's another 1% fee. So 12 months for a total of 4%. Okay. Then you sell your current home. Now you buy the house back from Revive. That's where I was saying we can take 45 to 60 days, right? No one else is competing with Revive to buy that house. You're under contract with them. Okay.
Yeah.
What Revive does is basically they set you up at a market rent. So basically you're set up with a rent to own basically purchase contract. Okay. So basically you're renting that property back from Revive after they purchase it in cash for you at a market rent data, okay, at market rents. And then again, once you've sold your current home, then you buy it back from them. And again, that timeline doesn't have to be rushed because again, you're already under contract with them. So
what if you have the 20% down, but you don't have a home to sell, but you want to be able to offer cash and do a 14, 20-day close?
Still works as long as the client's comfortable with that 3% fee. Totally.
Interesting. Cool.
There's some really interesting stuff coming out here from, this is all hedge fund stuff, let's be honest, right? They're trying to find interesting ways to get money through the market. This wouldn't be a product that would be coming out if home prices were going down, right? The risk on them would be substantial. But right, there's like almost zero risk to Revive, right? Home prices keep doing this. So if the client just decides they're never going to buy the house, they're either renting it at market rents or Revive's just going to turn around and sell it for probably a lot more than they just bought it for, right? So the risk to Revive is probably very, very low while this home prices continue to skyrocket. So that's why they're able to offer a product like this. But again, we know that cash buyers are just winning at an alarming rate. And this is kind of how to turn your clients into that. So any other questions, guys?
Good stuff.
Cool. Ideas, I will send you guys the PowerPoint presentation of this entire deck. So you guys will have all the slides. So if you want to go through this with your clients, you certainly can. And again, if you're going through it presentation virtually, loop me in. I'm happy to sit on the Zoom meeting and give context to all this stuff. And again, more than anything, just let's help some clients get under contract that have been struggling. So
awesome.
Cool, guys. I really appreciate your time today. Any last questions for the day?
Nope.
So
All right.
Thanks, Jason.
All right, guys.
Appreciate
Have a
it.
wonderful rest of
appreciate
your
it,
day. Talk to you
Jason.
later.
Thank you.